Hey everyone, big day today because the Federal Reserve is going to conclude their two-day meeting and then come in front of the press and say what they think about inflation, the economy, their monetary policy, all super important things that the stock market and the housing market want to know about the future of our economy. So it's really key because the Fed has a reputation of just being willing to print money into oblivion, but then saying inflation is probably not a big issue, and if it was, it'll be temporary. They say transitory. And the key issue with that is an ever-growing money supply is traditionally the main cause of inflation. So after a while, there's a divergence between reality and what the Fed is saying. And so in this video, I want to highlight for you what the business leaders, big tech, big banks, Wall Street traders, what they see, what they see happening, because they see a divergence and they're starting to put their bets in that inflation is not only here, but here to stay. So today's a key thing for the Fed to come out and test or show their credibility, because if they continue to say it's not a big deal, the market's really going to freak out, I think. And the key thing for us consumers is if the Fed says, the inflation is not an issue and not here in a meaningful way, and we don't think it's going to continue. We've already felt the price increases in housing, gas, food, transportation, healthcare costs. So many things have gone up in the last 12 months, and the rate of the increases has been more than in the last decade. So this is a big problem, and the Federal Reserve, which controls the money supply, if they're not in alignment with where reality is, then we need to be prepared to handle it on our own. So in this video, I'm going to show you what the big guys are doing. So go ahead and smash that like button. And when you do, it allows this video to be shown to more people like us who want to have the sense of what's going on, get ahead of the curve of what's happening in the economy, and be able to react properly when the Federal Reserve releases their statement. So hit that like button and let's get started. All right, quick definition on inflation. It is a persistent and substantial rise in the general level of prices related to an increase in the volume of money and resulting in the loss of value of currency. So this is generally reflected in a basket of goods that is measured in an index called the Consumer Price Index, or CPI. Now, the Consumer Price Index has 8 major categories that it measures. It's medical care, food and beverages, housing, apparel, transportation, education and communication, other goods and services, and recreation. So all of those prices of all those things get put in there, and that's what gets monitored. And that's basically reflects what we all use on a day-to-day basis to live our lives. And so when the price of those things goes up, that's the effect that we feel of inflation. Now, the Consumer Price Index is measured monthly. So back in April of this year, the basket of goods increased 4.2% on average. This was a pretty big increase, the biggest that has been seen, or the fastest rate of growth, rather, since September of 2008. So how do we know this is a problem? Well, I showed you what April was in the CPI. Let's take a look at May. It was 5%, and that's year-over-year comparison from May of 2020 to May 2021. This is a huge increase, and according to Yahoo Finance, the increase was 5%, as I said, but that was the biggest year-over-year gain since August of 2008. So what we're seeing here is a noticeable trend of that basket of goods increasing in price more than in the last decade. And according to Yahoo, this is a problem because April CPI reading intensified concerns that inflation is heating up and will be hard to contain, so the May data could stoke those fears further and contribute to a self-fulfilling cycle of rising prices. And that rising price trend really puts the Federal Reserve in a tough position, because in order to combat inflation, they have to either, do two things: raise interest rates and also stop the spending, stop injecting so much money into the system. The concern here is that this could get away from us, and there's actually nothing the Federal Reserve could do if they continue to wait to act. And so the fact that this could kind of spiral out of control is what the market is really concerned about. So this is an issue because the inflation rate set by the Federal Reserve is at 2%. That's their target. But we keep seeing it go past that. And once it gets, I think, to a certain point past it, they're just going to have to do something. They're going to be forced to take action that maybe they're not ready to take, or not at the time they're ready to take it. So this is an issue that's going to cause a lot of structural changes to our economy and the stock market. And it's important to now look at what are the big players doing to get set up and ready for it. So let's take a look at JP Morgan Chase. CEO Jamie Dimon says the bank has effectively been stockpiling cash rather than using it to buy treasuries or other investments because of the possibility higher inflation will force the Federal Reserve to boost interest rates. And this is the biggest U.S. bank by assets, and they've positioned themselves to benefit from rising interest rates, which will let it buy higher yielding assets. This is so important because if the Federal Reserve keeps saying that inflation isn't an issue, one of the biggest banks in the world is saying it is. And they actually are in the business of making money by making investments. Therefore, they have the wherewithal and the knowledge that we can see what they're doing. We should follow it. So if they're hoarding cash right now to buy higher yielding assets in the future on a bet that interest rates will increase, it's hard to ignore. For instance, Jamie Dimon says, we have a lot of cash and capability and we're going to be very patient because I think you have a very good chance inflation will be more than transitory. Again, that term the Fed likes to use to say that inflation won't last. Everyone's saying it probably will, and that's a problem. In another corner of the universe, a small company called Amazon has done something that I think is also an indicator that the big tech players see inflation as a huge risk and they're positioning for it now. So Amazon borrows $18.5 billion it doesn't need in a new debt sale. This was in early May, so just over a month ago. So they sold bonds to refinance debt and buy back stock as cheap borrowing costs prove too tempting to resist even for a company with tens of billions of dollars in cash. This is really important because they sold the debt in 8 parts. The longest portion of 40-year security yields 95 basis points over treasuries. That's a small, paltry amount. I mean, that's a very, very low return. And so that just proves not only how low interest rates are now, but the fact that they know it's such a good deal, they locked it in for 40 years. They want to pay a very low interest rate for a very long time. For them, it's effectively free money. And the small interest expense they will have is something they can deduct on their taxes. Oh wait, they don't pay those anyway, but that's a different video. And just another hint, Amazon is a very infrequent issuer of debt. So the fact that they saw this opportunity is just so good to jump in now, access of billions of dollars from the credit markets while interest rates are low. I think they're doing it now because they see interest rates going higher and they wanted to get while the getting was good. And finally, we spoke about JP Morgan Chase, but they're a bank and they have ways to make money through fees and they have your account balances on hand that they can lend out. We spoke about Amazon and they have a huge business and they make money not through financing primarily, right? So there's other ways they make money, but let's look at somebody who's a billionaire trader on Wall Street whose exclusive way that he makes money is by allocating his capital. And that's Paul Tudor Jones. He's a hedge fund manager and he actually called the stock market crash of 1987. He was in advance of that. So he's pretty prescient. He's very good at what he does. And of course, he's a billionaire. Let's look at what he said. He's paying close attention to this week's Federal Reserve policy meeting in light of recent economic data showing higher consumer prices. Again, that's that CPI basket we spoke about. If they treat these numbers with nonchalance, I think it will just be a green light to bet heavily on every inflation trade. If they say we're on path, things are good, then I would just go all in on the inflation trades. I would probably buy commodities, buy crypto, buy gold. So this is really interesting. He's saying if the Fed comes out and says an aspect of like, hey, we don't see a problem with inflation, to him that's saying the Fed has their head in the sand and is in denial. Inflation's here, go all in. Because you want to get in, especially before the Fed has to raise rates, because then by then it'll be too late to get in at lower prices on these assets that are inflation, counter to inflation, like crypto, commodities, which is like oil and things like that, and then gold. But then Paul Tudor Jones also goes on to say, on the other hand, the markets would be very unsettled if the Fed comes out with a very different tone, such as if they course correct and they say we've got incoming data, we've accomplished our mission, the mission being we've saved the economy and we've kept things stable, and now we see the economy rising again. and we've accomplished our mission, and we're on the way very rapidly to accomplishing our mission on employment, then you're going to get a taper tantrum. That's funny. You're going to get a sell-off in fixed income. You're going to get a correction in stocks. That doesn't necessarily mean it's over, though. So what he's saying here is that if the Fed does say, hey, we actually see some sign, we're looking at our data, we see that inflation is kind of a thing, and we think it's going to be around for a while, then that will be them admitting to what the market is already thinking, and that will cause a correction. So in essence, the Fed is really in between a rock and a hard place today, where they say one thing and the market's going to be like, don't believe you, we go down. They say, hey, we want to confirm what you're all thinking. They're like, oh my God, that's the worst scenario, down we go. So I think the market's in for a tough week after this, no matter what, and the magnitude of which all depends on how Jerome Powell handles the press conference and the Q&A afterwards. So in today's video, we covered a lot, and I think the main key takeaway is to keep your powder dry, like JP Morgan Chase. Let's go ahead and wait and see what the Fed does, and if based on how the sentiment, the phrasing, the wording of Jerome Powell, then we need to be like Paul Tudor Jones and read those tea leaves and go all in on the inflation trades if we hear those magical words, such as, we don't think inflation is here. You know, we're still trying to keep things all as normal. And, you know, and like Bezos, if you have credit lines that you can access while interest rates are still low, you should do it. Just to get the access, just to have it so you can use it when you're ready. All right? So that's today's video. Go ahead, smash that like button, and please share this video with everyone so that they can get the same information and make the same moves and be like big Wall Street, big tech, big hedge fund managers. Let's all grow our wealth together and get ahead of this curve. All right? Talk to you soon.